So what this allows Franco-Nevada to do is to get exposure to the price of gold, the price of oil, a whole ton of precious metals, commodities, without actually having to incur any of the operating costs. If we think about a traditional miner, they're exposed to the fuel costs, the labor costs, the equipment costs. We have environmental situations, bad weather that can impact, the overall margins of the company, whereas Franco-Nevada simply takes top-line revenue in terms of royalties. It collects that royalty ultimately for providing financing for getting the mine off the ground, helping them with operations, things like that. So it is a lot more steady business model. And this is why you see margins as high as they are. But let's move on to the bull case. The first bull case for Franco would be, as what I've mentioned, it is getting that gold out of the ground and benefiting from it without any operating costs. So typically their royalty streaming is on a top line basis. So if a company generates $1 million in revenue and Franco-Nevada has a 10% royalty deal, and keep in mind, I'm making these numbers up for simplicity, they will get $100,000. Now, that does not matter if the gold miner itself, if it took $500,000 to get that gold out of the ground or $800,000 to get that gold out of the ground. Ultimately, Franco-Nevada just gets that top line revenue, no operating costs. The miners bear the brunt of that, which is why they typically have very volatile margins, whereas Franco-Nevada does not.